Here is the hard truth that nobody tells beginners about investing. The secret to building wealth has nothing to do with finding the next hot stock. It has everything to do with three simple decisions that most people never even think about. And by the end of this video, you are going to know exactly how to build your first portfolio from scratch, even if you have zero experience and have never invested a single dollar in your life. Let me be real with you for a second. Investing does not need to feel like a part-time job. It should not keep you up at night stressing over market crashes or glued to your phone checking numbers every 5 minutes. If your investing strategy feels overwhelming, you are doing it wrong. The whole point of building a portfolio is to set yourself up for long-term financial freedom, and that should feel empowering, not exhausting. So today, I am walking you through three golden criteria that form the foundation of any strong portfolio. These are the exact principles that guide my own investing decisions. Let's get into it. Criterion number one is your asset allocation. This is simply the question of what you are actually putting your money into. At the most basic level, there are two main asset types every beginner needs to understand: stocks and bonds. Stocks are your growth engine. When you buy a stock, you are buying a small ownership stake in a company. The value of that stake can rise significantly over time, but it can also drop in the short term. Over the last 5 decades, though, the broader stock market has trended upward consistently. If you have a long time horizon, say 5 years or more, stocks are generally where you want most of your exposure. Bonds are the opposite in energy. They are slower, more stable, and act like a shock absorber for your portfolio. A bond is essentially a loan you give to a government or corporation, and they pay you back with interest. They do not deliver explosive growth, but they also do not swing wildly in value. When the stock market gets choppy, bonds tend to hold their ground. So your very first question as a new investor is not which company should I buy shares in? It is this: how much growth do I want and how much stability do I actually need right now? If you are in your 20s or 30s with decades before retirement, leaning heavily into stocks makes sense. If you are closer to needing that money, a bigger bond allocation protects what you have built. There is no perfect formula here. The right mix is whatever keeps you invested long enough to let compounding do its magic. Criterion number two is geographic diversification. This one surprises a lot of beginners because most people only think about investing in the US market. And yes, American markets are huge and full of incredible companies, but here is something worth knowing. There are years when other markets outperform the US entirely. In fact, Canadian markets significantly outpaced American ones in 2025. International and emerging markets have their own growth cycles that often move independently of what happens in the United States. When your entire portfolio is tied to one country's economy, you are essentially making a single big bet on that one government, that one central bank, and that one set of policies. Real diversification means spreading your money across different countries and regions so that no single economic event can derail your entire financial future. Think Canada, the US, Europe, and emerging markets all working together inside your portfolio. This brings us to criterion number three, your risk profile and time horizon. This is honestly the most important of the three. Two people can own the exact same investment and have completely different experiences. One sleeps soundly at night while the other panics every time the market dips 2%. The difference is not the investment itself, it is their relationship with risk and time. Ask yourself this honestly: if your portfolio dropped 15% next month, what would you do? Would you hold steady knowing you are investing for the next 20 or 30 years, or would that make you want to pull everything out immediately? There is no shame in either answer, but knowing the truth about yourself changes how you should build your portfolio. Money you will not need for a long time can handle more volatility. Money you might need in the next 2 or 3 years should be in something far more stable. The best portfolio is not the one chasing the highest possible return. It is the one you can actually stick with through the inevitable ups and downs of the market. So now you have all three criteria: asset allocation, geographic diversification, and matching your portfolio to your personal risk profile and time horizon. But here is where a lot of beginners get stuck. They understand the theory but have no idea how to actually put it all together without spending hours researching individual stocks and rebalancing constantly. The answer, and this is where things get genuinely exciting for beginners, is something called an all in one ETF. ETF stands for Exchange Traded Fund. Think of it as a basket that holds dozens or even hundreds of different investments inside a single purchase. Instead of buying shares in one company, you are instantly buying a diversified slice of the entire market. All in one ETFs take this concept even further by bundling global stock exposure, geographic diversification across multiple countries, and sometimes bonds all into a single fund, one ticker symbol, one purchase, instant diversification across every criterion we just covered. These funds are managed professionally, they rebalance automatically, and many now carry management fees below 0.2% annually, which is incredibly cost effective. For anyone just starting out, an all in one ETF can genuinely be the smartest first move you make. It removes decision fatigue completely. You are not guessing which sector to overweight or worrying whether you have too much exposure to one country. The fund handles all of that complexity so you can focus on the one thing that actually builds wealth over time, staying consistently invested. Here is your action plan. Start by deciding how long you are investing for and how you would emotionally handle a market downturn. That tells you whether you want a mostly stock heavy allocation or something more balanced with bonds included. Then look into all in one ETFs that match that risk profile and offer broad global diversification. Open a tax advantaged account if you have not already and start contributing regularly, regardless of what the market is doing. Wealth building in 2026 does not require a finance degree or hours of research every week. It requires consistency, patience, and a simple strategy you can actually stick with. If this video helped you understand where to start, drop a comment below telling me which step you are taking first. And if you want to go deeper on ETFs specifically, let me know that as well.